Listen, from the 30th of January 2026, I'll tell you one thing directly. In the precious metals market that most people miss completely, if you hold gold or silver now, you absolutely need to know what happened that day. In less than 30 minutes, the market erased $6 trillion in wealth. Gold prices plunged more than 12%. Silver plunged 31% in one trading day, its worst day in nearly 46 years. Here is what is interesting about it. It wasn't a random crash, nor was it an unexpected flash of lightning. What happened was that three huge forces collided with the market at the same time, all hitting at the same time. Once you understand what happened last Friday, you will understand why the precious metals market will completely reshape itself in the next 12 months. Finally, you will know what caused the crash, why it unfolded this way, and what it actually means for your future portfolio. Let's get started. Before we can explain what caused the crash, we need to understand what caused it. And this setup is absolutely crucial to what happens next. In January 2026, precious metals not only rebounded, but also in hot mode. In 2025 alone, gold soared nearly 65% and silver soared more than 145%. The price of silver more than doubled in 12 months. Gold from around $2,700 in early 2025 to above $5,100 in early January is not just the rebound you see in normal markets. These are structural repricing events, and the whole market is reassessing the actual value of something. Institutional money is pouring into precious metals because something huge is unfolding beneath the surface. Global debt has exceeded $340 trillion. Central banks around the world, China, Russia, Poland, Turkey, India, are systematically shifting reserves from US Treasury bonds to physical gold. Why are they doing this? Because they found that the dollar was not as safe as advertised. Not because of the policies of any one country, but because you can weaponize a currency, as the world has seen. When the West freezes Russian assets and Afghan central bank reserves, every central bank on earth receives the same message that your dollar reserves are actually unsafe and may disappear overnight. So what happens when you realize that your main reserve currency could be confiscated? What you move in cannot be confiscated, cannot be printed, has actual weight, and cannot be frozen. You enter the gold market. In addition, the geopolitical situation unfolds in real time as tensions in the Middle East escalate and the US-China trade war heats up again. Inflation concerns continue to emerge no matter how much the Fed insists that inflation concerns are temporary. All this has created a panic premium in the market, constantly pushing noble metals. By the end of January, gold hit $5,595 an ounce, and silver broke through $120 for the first time in its history. These are not just chart highs, but psychological barriers that traders believe will still be broken. When the rally became so strong and rapid, something dangerous happened. The market has become crowded, which means that everyone is long, everyone is bullish, and everyone is positioned in the same direction. A market where everyone is positioned the same way has become unusually fragile, like a building that carries too much weight. You can pile it all the time, but at some point the foundation will deform and crack, and the whole thing needs only one crack to fall. On the 29th of January 2026, the precious metal market was overloaded. What is interesting now is that because the crash was not caused by one thing, three different forces hit the market almost at the same time. which is why the losses were so severe. First force, Kevin Walsh and Fed Chairman surprise. This is the main event. That is why everything changed overnight. On Friday, the 30th of January, around the opening of the market, President Trump issued a notice that immediately caused an uproar in financial markets. Kevin Walsh has been nominated as the next chairman of the Federal Reserve, and nothing is clear. If you don't know who Kevin Walsh was, he was chairman of the Federal Reserve from 2006 to 2011. But what matters is his reputation on Wall Street, where he is known as a currency hawk. Hawks like higher interest rates, they like tightening monetary policy, and they believe in the ultra-loose money that has dominated the Fed for the past 15 years. Here is the key. The overall precious metals rally is based on expectations that the Federal Reserve will begin to cut interest rates frequently and sharply, which means the market is betting on more interest rate cuts, more monetary stimulus, and easier money pouring into the economy. But Kevin Walsh never did. After the news came out, the whole market narrative turned upside down in seconds. If Walsh is confirmed and becomes chairman of the Federal Reserve in May 2026, rather than the expected monetary easing, we may actually get the opposite result. Tighter policies, higher interest rates remain high, and the dollar will strengthen wherever it is. Why is this important for gold and silver? Because these metals pay no interest, pay no dividends, and generate no cash flow. The only reason you hold them is for two things: inflation protection or fear of currency depreciation. But when interest rates rise and the Federal Reserve tightens monetary policy, Treasury bonds suddenly become attractive again, the dollar is attractive again, and there is no reason to hold gold and silver anymore. The whole argument driving the rally, the whole story of the Fed being broken and gold needing protection, evaporated within minutes. The dollar index rose sharply in a few hours, up about 0.8% in a single day. When the dollar strengthens, gold weakens, which is quite directly related. But this is just the beginning, because while Mr. Walsh's announcement created a panic sell-off, something else happened in the context of making everything worse. The second force, index rebalancing and mechanical selling, this time is more technical but important because it explains why the sell-off is so severe and why it is growing so fast. Commodity indexes exist, such as the Bloomberg Commodity Index or the Goldman Sachs Commodity Index, with very specific built-in rules. The rules say that no single commodity can account for more than 15% of the total weight of the index, a diversification requirement designed to prevent any single commodity from dominating. What happened in early January was that gold and silver rose so high that they broke through the maximum weight allowed. And in these indexes, they are super large and far super large. But that is something most people don't understand. Billions of dollars of passive investment funds automatically track these indexes, which means that when a commodity becomes too big for the index, the fund has to sell it and has no choice. It is automatic and mechanical, regardless of whether gold and silver are good investments. It is just a rule. Therefore, when the index was reset in January, a large number of selling orders were removed from the shelves, and silver futures alone needed to clear about $5 billion in just a few days. Under normal circumstances, the market can absorb a $5 billion sell-off. But when the sell-off occurs, when the shuffle announcement causes real investor panic, and when everyone rushes out at the same time, things become dangerous. The third force, algorithmic trading and waterfall. That is why it is so ugly. Modern financial markets are based on algorithmic trading, where computer programs automatically execute transactions in milliseconds based on specific rules and triggers aiming to spot opportunities faster than anyone else. But when the market swings sharply in one direction, when the market begins to fall sharply, the algorithms do something dangerous. These algorithms detect volatility because they are programmed to sell when there is downward momentum. And they also start to sell, creating more downward momentum, triggering more selling, creating a cascade effect. Imagine a row of dominoes, one down, one down, one down, one down, and soon all the dominoes are down and you can't stop it. That is what happened to silver on the 30th of January, when the initial sell, off triggered by the Walsh announcement, triggered an algorithmic sell, off triggered stop loss orders, led to more algorithmic sell, offs, bids dried up completely, and few people were willing to buy. It is reported that around 7:16 p.m. London time, there was a situation called liquidity black hole. Orders were actually empty, sellers sold silver, and there were few buyers on the other side. That is to say, you saw those absolute disasters of 30 to 35% falling in a few minutes. Once the chain reaction starts, it is almost impossible to stop because brokers of leveraged investors call their margin and say, hey, silver has just fallen 20% and you need to put more money down now or I'll close my position, which will lead to more selling, which will trigger more margin requirements and more forced selling. As of Friday evening to early Monday, the overall plunge in precious metal valuations was shocking, with gold down more than 12% in a single day and silver down 31%. The Chicago Mercantile Exchange, CME, immediately responded by raising margin requirements, saying, yes, silver futures now require 15% margin instead of 11%, and gold needs 8% instead of 6%. But that will only make the cascade worse, as more leveraged traders are now squeezed out of the market, forced to sell more and liquidate more, and by Monday morning, the market was still in free fall. I know what you may be thinking now. The market is panicking and prices are falling, but why is silver down 31% and gold down only 12%? And why is there such a huge difference between the two metals? Market structure explains that, and that is where silver's weakness has really become apparent. Gold and silver are similar, but they are different. Gold is mainly a store of value held by central banks and the rich when they worry about a currency collapse. There are few industrial uses, and the amount of gold consumed each year is negligible compared with the amount stored. Silver is completely different. It has huge industrial uses. It is used in solar panels, electronics, data centers, and military applications. Here is what changed. It was consumed. Once silver is used in solar panels, it disappears forever. Once inside the microchip, you can't recover and it disappears. For decades, a large amount of silver has been stored on the ground. So the market has never worried about supply, but since the silver market entered a structural deficit in 2021, the situation has changed, which means that more silver is consumed than mined and produced, which has happened for 6 consecutive years. 762 million ounces of silver were extracted from above ground storage in 2021, 2022, 2023, 2024, 2025, and now 2026. As these above ground stocks dry up year after year and the market becomes increasingly fragile. The problem is even worse when you look at COMEX, the main silver futures exchange in the United States. As of mid-April 2026, there were only 76.8 million ounces of registered silver available for delivery in these vaults, but 575.5 million ounces were not closed, which meant that paper claims were superimposed on physical metal with a delivery coverage of 13.4%, of which 7.5 paper claims were placed on each ounce of physical silver. This is not a market. It was a powder keg waiting to explode. When the panic selling hit on the 30th of January, the market suddenly realized something terrible. There was almost not enough physical silver to cover all these positions, or even close. Speculators began to demand physical delivery rather than accept paper contracts. And when you tried to get physical delivery, you found that the vault was almost empty. So you had to pay more, and you had to pay a premium to get real metals, not paper contracts. With structural imbalances far more severe, it is harder for silver to plunge than gold. Silver has also been hit by the forced liquidation of leveraged positions, which speculators use to bet heavily on silver's rise and borrow money to make big bets, which are completely destroyed when the market turns. Imagine you have $10,000 in your account and use it to buy $100,000 worth of silver futures at a leverage ratio of 10 to 1. If silver falls 10%, you will lose all $10,000 and your account will disappear entirely. Now imagine thousands of traders liquidating at the same time, creating huge selling pressure. Silver fell not because of overvaluation, but because market structure revealed a huge mismatch between the amount of paper silver outstanding and the amount of physical silver actually available. This mismatch did not disappear after the crash. It still exists in the market, which is actually important for what happens next. Many people watched the crash and thought that the bull market in precious metals was over and the decline in gold and silver was no problem. It was all speculation and speculation, but that was not the case. Yes, prices have fallen sharply. There has been panic. Leverage has been lifted and forced out. But the reasons for the initial rise in gold and silver remain unchanged. The central bank bought gold at a record pace. Remember, why? Because they realize that their dollar reserves are not as safe as advertised. Did that change when gold plummeted? Has America suddenly become more trustworthy? Did global confidence in the dollar suddenly improve on a bad day? No, on the contrary, after tensions with Iran began to escalate, geopolitical risks rose instead of falling. So the root cause of the central bank's large hoarding of gold remained. What about the structural supply deficit of silver? Has that gone away? Did we suddenly discover a huge new silver mine that mines hundreds of millions of ounces a year? Is the demand for silver in solar panels and data centers suddenly gone? No, demand is accelerating, getting worse, not better. The world is building AI data centers at an unprecedented rate, each of which requires a lot of silver for cooling systems and electrical components. And the construction of AI data centers is inseparable from silver, which is not optional. In addition, China restricted silver exports on the 1st of January 2026, basically saying that we no longer sell silver to the rest of the world. Why? Knowing that silver is becoming scarce, they want to keep the supply going. On the one hand, demand rises. On the other hand, supply falls, the opposite of what is needed to curb prices over time. What happened on the 30th of January was a classic pullback, not a reversal of the entire bull market. When you have a few months of rebound and prices soar so fast, you get a pullback, sometimes 10%, sometimes 20%, sometimes 30% or more, as in this case. Callback is different from reversal. Callback tests the bull market and gets rid of weak hands and speculators chasing momentum. So if the fundamentals still exist, if the root cause of the rebound remains unchanged, prices will find a bottom and continue to rise. This is the status quo of precious metals. Starting on the 30th of January, prices began to recover and form in the next few weeks. At the end of February, gold rebounded to $5,300 and silver stabilized above $70, finding some support. Another geopolitical shock in late February triggered another brief sell-off, but by March and April, a clear recovery pattern had been formed. As of mid-April, gold traded at about $4,850 and silver traded at about $77, both below the January high. But importantly, gold rose about 8% throughout the year despite the crash, and silver rose about 16 to 20% despite the crash. The 8th of April brought an interesting thing that most people did not expect, with the announcement of a 2-week cease-fire by the United States and Iran, which you might think was bad for gold because lower geopolitical risks meant less demand for safe havens. But that was not the case, with gold surging 3% to $4,850 and silver surging 7% to $7. Why? The ceasefire statement, which shows Mr. Trump's willingness to negotiate with Iran rather than simply threaten military action, reduces some market uncertainty, which is actually good for markets when uncertainty sometimes falls, because fundamentals can dominate the center stage rather than fear. What are these fundamentals? Silver still needs to be used for solar panels and data centers, and gold is still hoarded by central banks that distrust their currencies. The Silver Institute has just released its latest 2026 supply report, confirming what analysts have been discussing for months. In 2026 alone, there was a structural supply deficit of 46 million to 67 million ounces. The 6th consecutive year of deficit, which is deteriorating, not improving or stabilizing. Fresnillo, the world's largest silver producer, has just cut its production guidance for 2026 by 9%. They are not mining more silver, but less, and they are the world's largest silver producer. At the same time, China is importing silver at its fastest pace in 8 years, paying a premium of 12 to 13% over spot prices and willing to pay significantly more for physical silver, a sign of how tight supply is. COMEX vaults are drying up, and in April alone, we saw 1.8 million to 3.15 million ounces of withdrawals per Dalton Y on certain trading days, real physical metals leaving the vaults, new supplies coming in, and new deposits with little rounding error. After the crash, after the panic, after the margin call, the fundamental supply of silver actually got worse. Wall Street has taken note of this, and major banks have begun to announce aggressive price targets for precious metals in the second half of 2026. Goldman Sachs has set a year-end gold target of $5,400. JPMorgan, Chase and Wells Fargo have set a year-end gold target of $6,300. And Bank of America and Citigroup have set a silver target of $150 to $170 an ounce. Whether these targets hit is entirely another question. But importantly, Wall Street has not said that the bull market is over and precious metals have been exhausted. They say the opposite. To sum up, the 30th of January is not a fundamental collapse of the precious metal market, but a technical event. 3 huge forces impact the market at the same time: Walsh announcement, index rebalancing, algorithm cascade. None of these things lasted. There was an exponential rebalancing, an algorithmic cascade, and the Walsh shock was a one-time event. So the conditions that led to extreme volatility did not repeat or continue to occur every day. In a strong bull market, correction moments happen all the time. And when you rebound as strongly as last year, it's precious metals, 65% gold and 145% silver, you get correction, sometimes sharp and sometimes painful for people with too high leverage and profit margins. But correction is normal. They are healthy. They are part of the way the market works. The fundamentals driving the bull market remain, and the global debt level has reached $340 trillion, which has not disappeared. This is the reality that the world must face. Central banks continue to hoard gold because they distrust paper reserves. This is ongoing and will not stop. Industry demand for silver in AI data centers and renewable energy construction is accelerating rather than slowing. The structural supply deficit of silver has not been solved for 6 years. These are not things that disappear because of a one-day crash, but structural problems that will take years to solve. I am not here to tell you that precious metals need to reach 100%, otherwise they will rise in a straight line from here without pulling back, and the market will not run like this. What I want to say is that if you understand what happened on the 30th of January, which is a technical event superimposed on strong fundamentals, then you have a smarter perspective on your positioning for the second half of 2026 for long-term investors thinking about 12 to 24 months rather than 12 to 24 hours. Callbacks create opportunities, prices fall, and the fundamentals of short positions have not improved. So for disciplined investors, this is a time to buy, not panic. It is natural for those who are overly leveraged and use margin to view precious metals as speculation rather than allocation, because leverage is the factor that turns a 12% correction into a liquidation account. Markets are not always rational, but over time they are. On the 30th of January 2026, the market became irrational and prices fell too fast and too far. But over time, the dust settles, the forced liquidation ends, and the market will eventually reprice based on the actual fundamentals of these metals. These fundamentals tell us that precious metals, especially silver, are more valuable than where they trade now. And I am not a financial advisor, so I can tell you how to use your money. But if you want to hold precious metals, you need to understand what happened on the 30th of January. You need to understand that there will be a pullback. And you need a long-term plan that be derailed by a day of panic selling. If you understand what happens, if you stay calm when prices fall, if you position yourself based on fundamentals rather than fear, you will be in a better position when the bull market continues. Much of the $6 trillion that evaporated on the 30th of January is coming back, and I think there will be more after that. Thanks for watching. If you find this helpful, like button, please subscribe below for more precious metals and financial market analysis, and comments to let me know your views on the future of precious metals. See you next time.